Hello, and a very warm welcome to Insurance Europe's Resilience Week. We are hosted, as you know, by the Hellenic Association of Insurance Companies and sponsored by Massage. And I would like to extend my sincere thanks to Massage for their continued support of our events. Now, today we will discuss the role of insurance regulation in resilience. And I am very happy to be joined in this discussion by Fausto Parente. Fausto, as you all very well know, is the Executive Director of EIOPA, the European Insurance and Occupational Pensions Authority. Now, Fausto and I will, discuss a number of questions relating to regulation and the role of regulation in resilience. There is also an opportunity for audience questions. So please use Slido. You have obviously received the link to it. As you are aware, you can also vote up questions that other participants have posed, and then we will know and take obviously the questions that are highest rated. But before Fausto and I get started on our discussion, I'm also very pleased to announce that we have Markus Ferber, a member of the European Parliament, who has graciously given us his time and has agreed to introduce this session with a number of starting comments. And I would now like to give him the floor. So please.
Dear ladies and gentlemen, thank you for the kind invitation and the opportunity to speak to you today. Resilience is commonly understood as the ability of a system or an organization to withstand and recover from external shocks. A little more than a year ago, our society and our economy have faced an external shock of unprecedented magnitude. I'm talking, of course, about the COVID-19 pandemic and the associated shutdown of large parts of our economy. I believe that it is fair to say that this kind of shock has tested the resilience of many on a personal, organizational and, of course, systemic level. 15 months later, when we can clearly see the light on the other side of the tunnel, it is safe to conclude that the European financial sector, and that includes the insurance sector, of course, have weathered the storm quite well. That proves that the Solvency II regime we have in place works well, at least when it comes to ensuring financial and operational stability of insurance companies. That is good news and an important takeaway ahead of the upcoming Solvency II review. To me, the performance and resilience of the insurance sector during the COVID-19 crisis proves that the focus of Solvency II review should not necessarily be on excessively increasing capital requirements for insurance companies, particularly given the fact that ensuring maximum resilience cannot be the sole objective of insurance regulation. As you may know, the European Union has defined very ambitious policy goals, for example, in the area of digitalization and moving towards a less carbon-intensive economic model. Achieving those policy objectives will require substantial investments. Insurance companies are arguably perfect long-term investors, as they have a long-term time horizon and predictable cash flow needs. So in that sense, the Solvency II review can be a chance. If we do it right, we can make life a little easier for the insurance industry, at the same time free of hundreds of billions of euros to support the EU's policy objectives. As is often the case, the devil is in the details, and specifically in the calibration of a few key metrics, for example, in relation to long-term guarantees and the extrapolation methods. We should be very much aware that you can kill even the healthiest insurance company if you calibrate those measures too harshly. So going to maximum resilience might in the end even be counterproductive. In insurance and in insurance regulation, being prudent is usually a virtue. But there is also a clear risk in being too prudent. In the end, we need to strike a careful balance. In my personal opinion, what we have seen so far as technical input by EIOPA has not yet been the exactly right trade-off, as it is very conservatively calibrated. The EIOPA proposals might focus a little too heavily on increasing resilience and are losing track of other policy objectives that might be worthwhile to pursue. Apart from the question of strengthening resilience and facilitating long-term investments, there are of course also other aspects of the Solvency II review. One aspect that is very dear to my heart is the topic of proportionality. In the banking world, we have succeeded in introducing a more proportionate regime for smaller and less risky entities. By doing so, we have not sacrificed resilience. After all, the more proportionate regime is also a more risk-based regime. While I am aware that we cannot transpose those banking rules one-to-one to the insurance world, I think the general approach on proportionality used in the last CDR-CRR package can provide some inspiration for the Solvency II review. To sum things up, resilience is a hugely important topic for insurance regulation, but is not the only game in town. In the Solvency II review, we need to balance the desire for resilience insurance companies with the need to have insurance companies that are capable investors and with a need to introduce more proportionality into the system. This will require a careful balancing act, but I do not think that there is necessarily a trade-off. There's a way to have insurance regulation that ensures resilience, proportionality, and long-term investments. I am now looking forward to the discussion between Fausto Parente and Michaela Koller to find out how we can best achieve these objectives. Thank you very much.
Well, thank you very much to Markus Ferber for his very interesting introduction in our topic. And Fausto, while Markus Ferber has very strongly focused on solvency, let's maybe start more broadly. When we look at the world as it is today, I think it is fair to say that risks are increasing in intensity, in diversity, and generally when we look at the definition of resilience, it is generally defined as the extent to which either companies or individuals manage to recover from an external shock. And also resilience is, a factor in how quickly they recover and to what extent they are harmed by these effects. Now, how would you look at resilience, from your supervisory perspective? Maybe first a general question.
No, first of all, thanks a lot, Michaela, for the kind invitation. It's really a pleasure to have a discussion with you, excellently introduced by our member of the parliament, which, by the way, has already some idea on our piece of advice to the Commission. On your question, resilience, as we know, the meaning is clear. What we believe resilience is at EIOPA, recently we are using this word to start a debate also with your help and to convince the government, the political masters, that we need shared resilient solutions. Because what we have experienced in the last year with COVID, but also before, the climate change, the systemic risk that we are facing as a society, cannot be coped with by the insurance sector alone. The answer to those big increased intensity, increased frequency of this disaster call for a cooperation, for a joint effort between all the players. Insurance is the key pillar here, can be part of the solution, but for sure cannot do it alone. So we are structuring a debate around the shared resilience solution in terms of having a public and private partnership to cope with the residual risk that the private sector cannot take on board. When I say private sector, means insurance insurance, reinsurance, capital market, whatever. But also we want to engage with the citizen to have a prevention measure in place to mitigate the effect of those disasters. Because one thing is for sure, another crisis will come anyway, because we know that this is unfortunately the way in which life works. So we have produced some documents, some discussion paper, also with the help of the industry, of our stakeholder. We need to convince our the government that this is the way to go. Otherwise, this word, the resilience, remains a nice word, but at the very end, the taxpayer will pay the bill of these disasters. Well, I think that is the time to change. It's time to really put together the effort and have a more resilient society.
Very interesting that you speak about the different roles that different parts can play in addressing these big risks as we just have experienced with the pandemic. I was a little bit hesitant when you talked about, obviously public-private partnership. Also, as the insurance sector, we were strongly engaged in these debates and stand ready also to continue working with you and other parties to address the question. For me, personally, however, I'm not sure I could agree with your statement that the residual risk that is not covered by the private sector would then be left, because that is probably not how we would see it in the insurance sector. But I don't know whether we now manage to agree on exactly the part that different players that need to come together to address this risk will ultimately play. I guess this is something definitely for a more longer term perspective. We had yesterday Commissioner Myra McGuinness in the opening statement saying the Commission is equally looking at these issues, and this will take time. But again, I think as the insurance sector, we stand ready and we are very happy to continue the debates with you. Let's move to solvency, given that we had Markus Ferber giving us a very nice introduction. We have, of course, Solvency II is the framework that is governing our industry. Is it now conducive, or is it a barrier to building resilience from your perspective?
Yeah, you said rightly, Mr. He made a nice introduction, you said, but it was nice maybe more for you than for EIOPA, to be frank, with all the respect, of course. No, we believe that it's conducive. We believe that, as it was acknowledged also by Mr. Ferber, the Solvency II has proved to work well during since the start of its implementation. It's proving to work well. We all acknowledge that this is the case. Also during the crisis, there was no need to adjust the regulation. There were difficulty, of course. The industry suffered as many other sectors, as all the citizens, but there was no need to change the regulation as it happened in other fields. So we can say that we are happy about the system. Still, the maintenance of a framework is important. And you know that even though I know that we disagree, but you know that already last time in the 2018, when we started the first work on updating the regulatory system, we suggested the Commission to change the interest risk module in the standard formula, because the reality we are facing already since a while now of negative interest rate was not foreseen at the beginning of the introduction of Solvency II. So we suggested already some time ago to make this adjustment. This was not, in the end, was not decided in this direction. And now, of course, on top of the other changes that we are proposing to improve and to continue to be conducive to resilient and long-term investment, there is also the issue of the negative interest rate, the extrapolation, which causes some impact on the market. We are reasonable people, as you know, Michaela. We are reasonable and prudent supervisor. It's not that we want to increase the capital. We believe that this issue of negative interest rates needs to be tackled. Otherwise, it will continue to sum up when, I don't know till when. But of course, we are aware of the impact, we are aware of the difficulty, and that's why we proposed also some phasing in, some transition, open to discussion, of course. The ultimate choice will be of course, from the two co-legislators, and we already know the opinion of the parliament. But we do believe that it's a system which is conducive to building up resilience. And to build up resilience, you need a solid and robust capital position, not overly prudent, but the right one, simply. I know that we disagree.
Well, let's start maybe with the positive first. I think where I would agree with you is that overwhelmingly Solvency II serves our industry well and really helps and is conducive to building up resilience. On the issue that you mentioned concretely, the interest rate and negative interest rate, I think we are consistently now on public record that we accept that this needs to be addressed. But of course, overall, and this is where we disagree, we believe that this increase that is justified can probably be very strongly balanced by areas where it would also justify to have, a different approach. You mentioned the 2018 review, where you had already presented the interest rate issue. At the time, what was also presented was, for example, a correction of the risk margin that was also not followed. Maybe, getting to a more balanced approach would require not only looking at the interest rate correction, but also at looking at other areas where we can actually bring and adjust the capital requirements to what is really in line with the risk. Because as you very well know, from an industry perspective, we have the feeling that while there are very few flaws in Solvency II, the measurement of the long-term business is a flaw. It tends to overestimate our long-term liabilities, also generally our risk, and also it tends to overestimate insurers' exposures to market volatility. And then, of course, we have the effect that it undermines our own resilience, because we are all of a sudden exposed to false alarms when we experience strong volatility. But it also undermines our ability to take away risk from clients. And we could take this risk, but currently either we cannot take it or it's too expensive. And thirdly, it would also undermine our capacity to invest. So for us, addressing the measurement issues and the volatility issue in long term is really key. But I know we will not be able to agree here in our discussion. At least I felt it was important to mention it. I don't know, do you want to quickly react on what I said, or should we move on to the next topic?
Maybe not with the hope to convince you, because I know that we will remain on our position. But just to highlight that we were also looking at something to balance the impact, no? And that's why we worked again on the risk margin. We propose, as you know, something that is much more now, let's say, hitting the burden of this measure. We also propose to adjust volatility adjustment, other long-term measure. We looked at property risk, but in the end, we couldn't make it to alleviate the property risk module charge because of the situation, lack of enough evidence to alleviate the capital requirement, and also in view of the COVID crisis. So just to say that if we are aware that when we propose something that has an impact, we need to look carefully of how we can counterbalance it, how we can make it in the end for the industry, because we want an industry that flourishes. We want an industry that takes risks. So it's not that we are not aware, but still the opinion was brought forward in this way because this was our, let's say, capacity to be prudent and effective. But as I said, open to other input, other discussion, and I know that the Commission is taking seriously care of the concern of the stakeholders. So really, I hope that in the end the final package will be a balanced one, taking account of the technical input from EIOPA and also of the need to have in mind other objective of the regulation, as was mentioned by Mr. Ferguson, the proportionality, the long-term investment. This is I cannot disagree on this.
Okay. I think this will certainly merit a debate just on its own. So let's move on to the next item that we would like to discuss is really pension resilience. You know that there is a huge savings gap. Last time I heard estimates that annually there could be up to 2 trillion, euros missing in terms of savings gaps. We in Insurance Europe, we did a survey where we found that more than 10,000 people have responded to the survey in 10 countries, and where we found that more than 60% of the respondents have also said that security in pension and in pension savings is very important. And I have also a quote here from your own relevant report where you say that 20% of EU citizens are at risk of poverty or social exclusion in old age. So clearly we have here also, again, a policy approach where we really need to look, are we doing the right thing for the future pensioners? What we have seen certainly in recent years was a shift away from the industry, again, for the reasons explained or discussed earlier, the long-term measures hitting, of course, more strongly on guarantees. So we see a shift away from these products to unit-linked products where we place the burden more on individuals. What I wanted to check with you is there is a recent interesting development in Sweden that is happening, and there are pension providers who have been under the Solvency II regulation so far have now an option to convert their corporate status so that they can be covered by an alternative set of rules, and in that case the Swedish local implementation of IOPS. And what we are seeing now in Sweden is that major pension providers are in fact switching their status. And I have a quote here from a trade union pension company that said, and I quote, "We move away from Solvency II to lay the foundation for better occupational pensions and," again quote, "to be able to continue investing wisely and long-term." So for me, the question that poses itself here is that we have, of course, Solvency II as the one element, but when or if we see now a development like this within the European Union, how do you react like this? And how do you react on it? And shouldn't we try to improve Solvency II in such a way that we avoid these kind of developments?
No, I agree that on both the objective. But let me remind everybody that first we issued some time ago an opinion on how to improve the IORP system to have a more risk-based regime also in the other sector. What we register, of course, is that nowadays the pension provider, let's say, respect or are under different rules. Solvency II, maximum harmonization, a certain approach, which as we said, we believe it's working, and IORP 2, which is still, in our opinion, this is what we suggest to the European institution, can be further improved. Let me say so. And unfortunately, the opinion of EIOPA was not considered in the end by the co-legislator. But I think that it was a good way to go if they would have taken it. On improving Solvency II, we mentioned the opinion recently for the 2020 review is already including some of those measures. You know that we want to foster illiquid liability to facilitate more than facilitate. I don't like the term facilitate, but it's more to consider maybe than when you have illiquid liability, you can invest more in long term. The capital requirement can be reduced because of a diversification effect and so on. So some measure on how to adjust and further improve Solvency II. On the other side, IORP 2 will come, can be an option to improve also that area. I don't know why the Swedish colleagues said that we need to move away from Solvency II. I do believe that we can stay in Solvency II and provide a pension. But what is important for us all, in my view, is that pension is an issue that needs to be taken as a society. It's like what I said about the climate change and protection gap. Too many people are simply not thinking about their retirement, how much they will earn in the retirement age. And the public system, we know, cannot do so much in the future. Life expectation is increasing. So are we doing enough as we as EIOPA, as the insurance sector, to really enhance the awareness? You know that now we are working under the Capital Market Union aegis on this pension tracking system, pension dashboard, all measures that can serve the purpose of to enhance the people awareness. Because what we need to say simply to the people that they need to save more. I know that is a difficult topic, especially now, which in this crisis time, but it's unavoidable. So the more we do an attractive offer, the more we inform people that this is an issue for them to tackle when they are still working, when they are still young, the better for the system and for the society as a whole. We have some initiative in this regard, as you know, I quoted the pension dashboard, pension tracking system. The IORP 2 will come, the revision of the IORP 2, and we have also the PEP. Let me say, we have worked, as you know, Michela, we have worked a lot on the PEP regulation as EIOPA. We do hope that this will be another option for citizens to save for their retirement. I know that still is a bit unclear how much this product will fly for citizens because of many reasons, taxation, whatever. But I do hope that this can serve at least the purpose to enhance and to spread out the debate about the necessity for people to save more. Then they may choose PEP, life product, IORP, occupational pension, but they need to save more. Otherwise, this is to be taken as a system. On this, I think that we can have joint forces together. We can join forces. We need to.
Absolutely. Sorry, I didn't mean to interrupt you. And clearly, I commend you on all the work that you are doing on the pension dashboard, also the tracking system, generally raising awareness. Also, your recent initiative to do more on financial education. There could maybe be also thoughts be given, to draw awareness to the pension field. So clearly, a lot is already happening. I take your point on the IORP revision. So let's see how this pans out. Maybe that would also be made easier if, the right measures were introduced in Solvency II. But that is clearly also a debate for the future. Let's now move to the broader regulatory framework that is governing the insurance sector. So I'm moving now also explicitly to conduct regulation. First, very easy question. Do you think it's digitally friendly?
No, we need to improve it. The IDD review will come, we still don't know when, next year maybe. We need to improve a bit the digital friendliness of our distribution system. This is a bit the problem with unfortunately, with the regulation. And when you set it, then it takes some time to implement, to adjust, to check if everything is fine. And the market, of course, is much quicker than the capacity of the legislator. So we need to have in mind the maintenance of the legislative framework as one of our major objectives, and we need to learn to fix at the level one more, as we say many times, but then we end up in having different outcome. We need to put in the level one, which is the more burdensome to change, the principle, the concept, those things that then the implementation of the level one can be more quickly updated depending on the market developments. In the IDD, there is basically a list of items for information. It's written there that the paper needs to be given to clients. And now, of course, to change this rule, you need time, basically. No? You need time. So was it necessary? I was there when the directive was negotiated. So it's also my fault. I don't think it was necessary, but it was like this. And we need to acknowledge maybe sometimes we need to be self-critical and refrain from putting too many things in the level one, because the level one is difficult it becomes obsolete quite soon, because the market is much quicker than the legislative process. That's the issue. Anyway, is it what it is now?
Yeah, well, I mean, I was there too, and I recall the discussion. Clearly, what we have seen, I think, in the pandemic now is that we need to move away from paper-based as a default. And it's good to know that we are going in the same direction. So let's hope it works for the next time. I use a very quick moment. I have just checked Slido. We are getting a couple of questions in, but I would encourage the audience, please post your questions. There will be time at the end. Moving on, you have mentioned IDD, and I know EIOPA, you yourself, I think Gabriel also was on public record with saying EIOPA takes conduct regulation just as seriously as it takes prudential regulation. Now, for the last 10 years, EIOPA has clearly been shaping conduct regulation in Europe. From our perspective, there are a number of very good outcomes. You mentioned one, the IDD, that seems to work very well. There are also proposals that didn't work so well. One that comes to mind, obviously, is PRIPS. You will not be surprised that I mentioned that. Now, the question is, when we look at consumer information, are you happy with the developments? Because what we have seen over the past years was an ever-growing increase of information requirements. We are now in a situation where consumers hardly see the wood for the trees. So first question, what can we do about information requirements? And the second question I would have, and maybe you can take them in combination, when we look at the PRIPS kit, we see, basically a very strong focus on costs, charges. Sometimes, I think for some products, up to 7 price indications needs to be given. But if we have learned something in the COVID crisis now is that what consumers and also businesses are ultimately really interested in is also cover. And we are not drawing enough attention on the extent of the cover and, also what is included, what is exempted. So do we also need to change here? These are essentially my 2 questions on conduct regulation.
Yeah, first of all, let me confirm that we attach the same importance to the conduct supervision or regulation and the prudential. For us, the two are part of the consumer protection mission that we are mandated by law. So if you are not a prudent supervisor, you don't have a solvency, and so nothing will come as promised by the insurance undertaking. But on the other side, if you do not conduct your business in a fair way, having in mind the interest of the policyholder, also this can endanger the trust of people into the system. So this is why we consider the two things going hand in hand. As you said, that there were a lot of, in my view, good achievement from a EIOPA perspective. Also on the conduct side, we produced a strategy. We agreed among all the supervisors to follow up on that strategy on conduct of business supervision. But still, let me say that a lot needs to be done. First of all, because the IDD is not maximum harmonization, as you know, and we have seen, if I remember correctly, 17 national member state option, which makes a bit difficult also to really exploit all the forces of the internal market, because if every country has different conduct rule for the player, the biggest, the smaller, the one that want to use the single market is a bit an issue. So there is still, in my view, room for improvement. On one area for improving is actually what you said, the information, the disclosure information. On a personal basis, I can tell you that the scope of the PRIP regulation has always been, for me, a bit too wide, personally. But I know that we, as a supervisor, we have made all the effort possible to make it not easy, because it's not easy for consumer, but to make it workable at least. This is one of the example I would quote as level 1 too prescriptive, because now in a number of issues that we were trying to solve at in the supervisory community, there is a need to adjust or change the level 1. So it's not. I think that this is some lesson for the future. Is again what I said. Try to limit the level 1 to have more possibility to adjust depending on the experience and the market development. On the consumer, the philosophy of the consumer disclosure, we recently discussed it also in our board, has to be changed. The information is not enough if we do not consider behavioral science, how people really act, and we know that sometimes people are not simply economic rationally acting. Not they, because we are also people. We act as we act, and so we need to consider behavioral science when providing information. Use ICON, I think that a good example can be seen in the non-life disclosure that we set up under the IDD mandate, which uses ICON, uses simple words, and this is the way to go in our view. Let's hope that now the new strategy from the Commission, this work on revising a bit the strategy to enhance and engage more and more retail investment will produce what we hope for. So in a simple word, are you happy about the information disclosure on nowadays? Not so much. I think we can improve a lot depending on the basis of the evidence and the experience we have gained. On the coverage, you are perfectly right. The business interruption case, it's always a pain when you need to go before a court to understand if you are covered or not. And this is painful for the industry, for the citizen, for everybody. This is simply simply not what we would like to see, because enhancing consumer trust means having a clear understanding of what the product can offer, mitigate and reduce or eliminate expectation gap between the consumer and the provider of coverage. And this is the way to go. The rest for the court is simply, something that does not help the market, does not help the society to continue to grow. So a lot of things can be improved, I'm sure.
Okay, so the chances that we hopefully get in the planned review a stronger focus on cover and maybe generally a stronger focus on the specifics of insurance, because, I think what we are struggling with is that currently 90% of EBIPs are in fact insurance-based investment products. So 90% of products under the PRIPS scope. But we don't feel that, we have the possibility to explain our products correctly. There's hardly any space for the cover. And if we can take some ideas in also presenting the products as developed by the IPIT under the IDD, that would definitely be a good way forward and something we could maybe agree on. So hopefully that...
I don't know if you like it, but for example, on the PEP, I believe that we made a better job in also, explaining the product with some guarantee, the product with no guarantee. So that area, in my view, is already an improvement compared to what you said.
Well,
let's use the PEP then.
I don't want to now sour the mood a little bit, so I have just not commented on the PEP earlier. I'm not sure we would agree to take that as a good example, even the kit. But that is probably, again, worth a separate discussion, and definitely something that we should consider, once we have... we enter the implementation phase, which will be March next year. I know that you are really looking into the issue because, of course, with registration and product approval processes, there will be a lot of work also for you from the supervisory perspective. And we will look at it with interest because, as you know, we have a long list of questions still that we would like to see addressed and clarified. And hopefully this could then actually lead to the presentation of some PEPs. But at this stage, I guess too early to say this is a good example because simply there are too many question marks still left. I'm mindful of the time. In 5 minutes, we should go to audience questions. I have still 2 short questions, if I may. The first is, we have other protection gaps. When you look climate, cyber, what can EIOPA do to address this? Maybe a short response. And then I directly ask you my second question, then you can think at the same time. You are now 5 years Executive Director of EIOPA. Your mandate has just been renewed for another 5 years. And I was just wondering, what is the thing that you are most proud of? And what is the thing that you regret and would change? And you have a chance to change it, in fact, in the next 5 years. So these may be my 2 last questions before we then head into audience questions.
On the protection gap, I think that whatever is the kind of gap, we need to work together, and the solution is always similar in our view, shared resilience solution gap to address the protection gap. Information is key, as we said. It's the same as the pension gap. It's all the same story. First, people need to be aware and act, because without action by people, nothing will change. And then we need to have a system where if there is an uninsurable risk, this uninsurable part of the risk needs to be tackled anyway. This may regard the climate change risk, the catastrophe risk, not the pension gap, because the pension can be worked by excellently. On your second question, it's a good question. I think the best achievement we did in the last 5 years is to really set up a supervisory community which is cohesive enough, because EIOPA sometimes is, wrongly perceived as those group of people that stay in their tower in Frankfurt. They don't know the market. They don't, it's not true. The EIOPA is made up of thousands of people coming from the national authority, working together every day. I don't know how many meetings we hosted in the past when it was in-person meeting, and now virtually even more, because with virtual, this is, by the way, a good advantage, because the virtual meeting will enhance the capacity to work together wherever you are located. Think about our Cypriot colleagues that to come to Frankfurt, they came, in the past they took 1 day, and now they can simply connect and work together. So this is I think the most important achievement. Just to quote the sense of community, we set up supervision, the key principle for good supervision, which were shared. So it's not a product, but really a sentiment and a feeling, an inclusive feeling to stay together on the same side of the world, because supervising is not an easy job, as you know. On what I would like to change, honestly, is some rule, maybe we touched upon some of them. Some rule that we fixed in the past, for example, some guidelines that were issued. Personally, I would have, if I had the chance to change it, maybe I could have now the opportunity to change. It's important to acknowledge that we do our best. Sometimes because of the level 1 or level 2 or whatever constraints, and the desire to give instruction to the player because of supervisory convergence need, that maybe we make sometimes things a bit too complex. And just to be explicit, I'm referring to some rule on how to sell a product with or without advice, execution only, non-execution only. This area of our guideline, I think, are a bit complex, honestly. I would love to have a system of distribution where really people can engage with their distributor, whoever is it, virtual, compare it, whatever, in an easy way, because what we need is to have better coverage, to enhance in the end the society coverage against risk. I know that it's easy to say, but a little more difficult to do. But if there is anything that I would like to change, is some of those detailed rules, which I believe were a bit complicated. Yeah. With all the respect for my staff and the decision taken, but yeah, you question and I answer.
Yes, and I thank you for your honesty, and I hope we have opportunity to, and you have opportunity to do that. Now moving to the audience questions, we have actually quite a number of questions, 8 in total, and the top rated currently, if I can read it out, Fausto, to you. If the outcome of the Solvency II review is a reduction in capital requirements without transitional, would EIOPA consider that the review is successful?
But it's not, if I can say, what we target is not the increase of the reduction of the capital requirement. We have made clear our opinion. We are ready to discuss. But if the final negotiation will be very, very different different from our opinion, I don't consider honestly this a successful negotiation, to be frank. But not because of the increase of decrease, but because the technical input are important.
Okay. Next question, also very strongly supported. This time again, Solvency II on macroprudential resilience. How does EIOPA justify significant extension of scope of requirements compared to the IAIS standards, especially scope of recovery plan?
No, I don't think that we are going beyond IAIS. These are two parallel projects that our ambition and our target has always been that we avoid, double requirement, double counting, double standards. This is our aim. So let's see what is the idea behind this extension, but I don't think that it's an issue, honestly. And our ambition is to avoid double burden. So let's see.
Okay, this is something where I'm a bit surprised, because I think that you are going beyond what is IAIS standard recommendation. But probably another thing that merits more in-depth discussion.
Yeah.
And we have still a long list of questions. We have another question. How do you see the relationship between resilience and proportionality?
You know that proportionality was since the start one of the founding principles of Solvency II, as is also one clear example of something that needs to be maintained or adjusted because it's not working properly, at least not working as was expected to work. So I don't see a direct impact, because proportionality is part of the resilience. As the introductory statement said, there is a possibility to have both of them. Proportionality, if rightly applied, does not diminish resilience. And our opinion, I think, goes into the right direction to implement the proportionality principle in a better way.
Yeah, and we would definitely also commend you for, the steps you have taken. Maybe, in one or two cases, we could go a little bit further, but broadly, I think direction of travel, something that we definitely recognize. There is another question on COVID-19 and lockdowns. They have forced Europeans more online. What conclusions has EIOPA drawn about the digital resilience, both of insurers and their customers?
No, I think we are coping quite well with the digital transformation, because everybody were forced, basically, to embrace digitalization. So it's not without risks, we know, but the digital transformation will bring a lot of benefit both for industry and consumer. For industry, it will reduce a lot cost burden. I'm sure that it will be beneficial. For consumer, the same, better product, more easy to engage 24 hours every day to stay in contact is something that can be appreciated. There are drawbacks that we need to tackle and consider, so that's clear. As everything comes, nothing comes without risk, let's say. But this is a positive outcome. I do believe that it's a positive trend. Yeah.
Okay. Next question, going back to Solvency II. Does EIOPA consider that its advice would reduce volatility? And the reference is to the new extrapolation or risk correction factor. And there is an additional question, didn't EIOPA endorse the CMU action plan on Solvency II, ?
Yeah, this is an area where, again, we can't maybe convince each other. We do believe that we have implemented CMU with the push for more calibrated requirement when there is an illiquid and long-term liability. And this is a way to foster long-term sustainable investment. So we do believe that we have considered the CMU principle. We also believe that the adjustment on the volatility, the 85%, the fact that if they back illiquid liability is reduced, are already tackling the problem of volatility, overshooting, undershooting. Let's focus on the matching between asset and liability also as a mean for the industry to cope even better with the volatility, artificial, not artificial. We can have debate on when is artificial and when is not. But we do believe that we have considered it. Now, is it enough? Depend on the taste. That's clear for me.
Okay. Then moving on to climate-related risk. From EIOPA's perspective, what are the major climate-related risks to financial stability for the insurance sector? And the question is specifically in comparison with the banking sector.
Well, I don't know actually in comparison with the banking sector if there is any specific, don't have a precise idea, to be frank. We do believe that the climate risk, the insurance role is different because we can offer coverages. And when this coverage is offered, our task as supervisor is to address the solvency of this process, not the sustainability of the promise to pay the losses. And with the increased, as we said, with the increased frequency and intensity, this is already per se a job that we need to consider both from a supervisory and industry side. This is something which is very specific of the insurance undertaking and insurance sector. For the rest, I think we need to go into the same direction. We have produced already now some guidance to introduce the climate change risk in the ORSA, which is, as you know, the way we start the dialogue between insurer and supervisor. So first of all, it will be the insurance undertaking to understand the impact on their future planning. So let's see. It's an area where no final word, in my view, can be said already. So.
Okay, thank you very much. I think we are slowly but surely coming to the end of our session. Last question that I can take here: what about the resilience of EIOPA and the national supervisors?
I can talk about EIOPA resilience, and I think we have overcome the good challenge now with the COVID. From one day to another to switch, as many other institutions, of course, I know. But I remember last March when we started to smell the necessity to work remotely. We did some tests, the IT tool. We had, of course, contingency plan in place, critical function. All the requirement we pose on the industry is also for us. But when you really need to take it, there is always 1 minute of suspense, and we say, let's cross the finger. But I must say that everything worked well, and from one day to another, we tested our system, and we were able, and now it's 1 year and more, to continue to deliver, even though from many time from remote. So it's fine. I think that the resilience of EIOPA is proved, if I can say so. And now we have also this period now without a full-time chair, which is something that we would have really liked to to avoid. We are overcoming it thanks to my staff, which is excellent. Thanks to Peter Bromüller, who took on board the task. And now it will be solved. So fine. Resilience of EIOPA is there. So.
Yes, and I'm sure everybody is looking forward to Petra Hielkemmer joining on the 1st of September. But for now, Fausto, I really want to thank you for a very open and frank discussion. I really found it very interesting, and I'm looking forward to our further exchanges. So I'm closing this session of regulations role in resilience, but not without inviting the audience to our next sessions. On Monday, we will discuss climate resilience, and on Tuesday, pandemic resilience. And I close this session again with a thanks to our sponsors, Massa, and a thanks to Fausto for his openness, and to Markus Ferber for introducing this session so expertly. Thank you very much, and I hope you have enjoyed it as much as I did. Goodbye.
Thanks a lot. Bye. Thanks a lot.